Welcome to the Deep Dive. Today we're heading off planet, taking a look at the Q1 2025 earnings for Intuitive Machines. That's ticker LUNR. You sent over a really interesting collection of articles and analyses on them. They're definitely, pushing boundaries in space exploration.
They really are.
So our mission today is to pull out the key insights, help you figure out what's really important from their recent performance, and maybe what it signals for the future.
Exactly. So whether you're, following the space industry closely, or maybe you're more into the financial side of things, or honestly just fascinated by moon missions.
Which are pretty cool.
They absolutely are. This deep dive should give you a clear, engaging look at their latest quarter. We'll break down what really counts.
And just so you know how we'll tackle this, we've set up 5 chapters. First, an executive snapshot for the overview.
Okay.
Then Chapter 2, results versus expectations. How do they actually do compared to the forecasts? Chapter 3 digs into the drivers and management highlights, what's behind the numbers, and what did the leadership say. After that, Chapter 4 looks at their outlook and the key metrics to watch. And finally, Chapter 5 will wrap it all up with our bottom line takeaways.
Sounds good. And we actually have a pretty exciting piece of news to start with. Intuitive Machines did something in Q1 2025 for the very first time.
Ooh, okay. Intriguing. Ready to find out what?
Let's do it.
Great. Let's get started then.
And hey, if you find this deep dive useful and want more detailed financial stuff, including AI-driven analysis on companies like LUNR, make sure you subscribe to the Stock Analytics AI YouTube channel. They do really in-depth looks.
Good tip. And just a reminder, we'll have the standard financial and AI disclaimers at the end of the discussion.
Always.
Okay, let's jump into Chapter 1, Executive Snapshot. So what's the big picture from this quarter?
Well, the headline number is revenue. $62.5 million for Q1 2025. And what's encouraging there is it's actually up 14.4% from Q4 2024, so the last quarter.
So sequential growth. That suggests some momentum, right?
It does suggest momentum. And here's that first ever thing I mentioned.
Yeah.
They hit positive free cash flow, $13.3 million.
Wow, okay. For a space company like this, positive free cash flow, that feels really significant.
It is. It's a big milestone. And it looks like it's part of a trend, not just a one-off. This was actually their third quarter in a row with a positive gross margin.
Oh, okay.
And that margin expanded, too, up to 11%. So they're getting more profitable on their actual projects.
And their overall cash situation sounds like that's looking pretty healthy as well.
Definitely. They finished the quarter with $373.3 million in cash, a really strong position.
$373 million. Wow.
Yeah, and a big chunk of that came from completing their warrant redemption, which brought in cash, plus that positive cash flow from operations we just talked about.
Got it. So operationally, what was management focusing on during Q1?
The reports really highlight, continued focus on execution, delivering on their main programs, CLPS, that's the Lunar Payload Service,
Right.
LTVS, the Lunar Terrain Vehicle, and NSNS, their Near Space Network Services.
Okay.
And importantly, they're also making strategic moves to diversify, particularly into national security space.
Interesting. And looking ahead, what guidance did they give for the full year?
So for 2025, they're guiding for revenue between $250 million and $300 million.
$250 million to $300 million. Okay.
Yep. And on profitability, they've set some pretty clear targets. They want to hit a positive run rate for adjusted EBITDA by the end of this year, 2025.
Okay. Run rate positive by year end.
And then be adjusted EBITDA positive for the full year, 2026.
That positive free cash flow number. Why is that such a standout metric for a company like Intuitive Machines? What does it really signal?
It's a really crucial sign of financial maturation, I guess you could say. Positive free cash flow means the core business itself is now generating enough cash to cover costs and have money left over,
Right.
which they can then plow back into growth, R&D, maybe even acquisitions, without constantly needing outside funding. For a capital-heavy field-like space.
Yeah. Hugely capital intensive.
Exactly. Becoming self-sustaining like this is a major validator.
Okay, so less reliance on the capital markets, potentially. And that big cash pile, the $373 million. What doors does that open for them strategically?
Oh, it gives them a ton of flexibility. They could look at M&A, maybe acquire complementary tech or market access, or they could double down on R&D, accelerate development of, say, that nuclear propulsion tech or other advanced systems. In this market, having that kind of cash on hand is a real strategic weapon.
Right, provides options. Okay, let's transition then to Chapter 2, results versus expectations. How did these headline numbers actually stack up against what the analysts were forecasting?
Okay, so revenue, that's $62.5 million. It was a bit of a mixed bag compared to estimates. It actually beat the Zacks consensus estimate, which was around $59.4 million.
Okay, so better than one forecast.
But it came in slightly below another estimate from Perplexity Finance, which was looking for about $66.1 million.
So landed in between, basically.
Mhm.
What about year over year and quarter over quarter? You mentioned the positive quarter over quarter.
Yeah, that 14.4% sequential growth is a good sign of momentum. But interestingly, the Q1 revenue was actually down 14.6% compared to Q1 of last year.
Oh, okay. Why the drop year over year?
It likely comes down to the timing of contract milestones and revenue recognition. Space contracts can be lumpy.
Right, project-based.
Exactly. Q1 last year might have just had some larger milestone payments hit that didn't repeat in the same way this Q1. The quarter-over-quarter increase is probably a better indicator of the current operational tempo.
That makes sense. Okay, what about the bottom line? Earnings per share, EPS.
They reported an EPS loss attributable to Class A common shareholders of 8 cents per share, so $2.08.
A loss of 8 cents. And the forecast?
That was actually better than expected. The consensus estimate was for a loss of 10 cents per share.
Ah, so a beat on EPS, even though it's still a loss.
Correct. Better than expected loss.
How did that compare year over year and quarter over quarter?
Well, the year-over-year improvement is pretty dramatic. In Q1 2024, the loss was $2.70 per share.
Whoa, okay. Big difference.
Huge difference. Now, a big part of that difference was a large non-cash loss on issuance of securities back in Q1 24, about $68.7 million. That didn't recur.
Ah, okay, so an accounting item influenced that comparison heavily.
It did. But even setting that aside, the underlying operational improvement seems significant. And sequentially, it was also a big improvement from the large net loss they posted in Q4 2024, which was around $165.1 million overall.
Okay, so can we quickly summarize the results versus expectations then? Kind of a scorecard.
Sure. Revenue, $62.5 million, beat one estimate, missed another, down year over year, but up nicely quarter over quarter.
Right.
EPS, loss of $2.08 is better than the expected $2.00 loss. Big improvement both year over year, even with that caveat, and quarter over quarter.
So revenue, a bit mixed versus forecasts, but earnings beat, and the trends, especially sequential revenue and the EPS improvement, look positive.
That's a fair summary. Yeah, the underlying trajectory seems to be moving in the right direction.
All right, let's move into Chapter 3, Drivers and Management Highlights. What were the key messages from the leadership team? What did they point to as driving these results?
The main theme from management, particularly CEO Steve Altemus, was really about unwavering focus on execution.
Okay.
Delivering on their programs, leveraging their track record. He also talked quite a bit about adapting to the, let's say, evolving federal landscape, how the government buys tech.
Right. And it sounded like they see shifts at NASA not as a problem, but maybe even an opportunity.
Exactly. That came through strongly. They view changing priorities, even within NASA, as a chance to expand, especially into national security space and other non-lunar areas. It's clearly part of their diversification strategy.
Makes sense. And the CFO's perspective?
CFO Pete McGrath really hammered home the strong Q1 financials, the sequential growth, the gross margin expansion, that first-time positive free cash flow.
Yeah.
And he stressed the strong cash position, the $373 million, highlighting that it came with no debt. He specifically called out the warrant redemption success, bringing in about $148 million of that cash.
Now, they had that landing anomaly with the IM-2 mission. How did they talk about that?
They addressed it directly, framing it very much as a learning experience, which, is crucial in this business.
Sure. Fail fast, learn fast.
Kind of. They outlined specific technical fixes for the next mission, IM-3 things like redundant altimeters, better sensors. It shows they're analyzing, adapting, and improving, not hiding from it.
Good. And did they talk about their broader sort of long-term vision?
Yeah, they did. They're positioning themselves not just as a mission provider, but as a, quote, broader infrastructure and data services provider across the space economy.
Okay. So thinking bigger than just point-to-point delivery.
Exactly. More like providing the picks and shovels or maybe the roads and data networks for the whole space economy.
Got it. So if we boil it down, what were the main positive drivers this quarter?
Okay. So, one, growth and solid execution on the core programs, CLPS, LTVS, and SNS. 2, better operational efficiency and that shift to higher margin services boosting the gross profit. 3, the timing of milestone payments definitely helped drive positive operating cash flow. And 4, that successful warrant redemption cleaned up the capital structure and significantly boosted cash.
And on the flip side, the challenges or negative drivers.
Well, obviously the IM2 landing issue, while framed as a learning chance, is still a challenge they need to fully address.
Right.
They're still showing an operating loss, even though it's improving. And they acknowledge the reliance on government contracts, especially NASA, and the potential risks if priorities shift significantly.
So the overall narrative for management is,
It's about building a resilient, diversified space company. They're actively pushing beyond NASA into national security and other areas. They seem transparent about challenges like IM2, but focused on solutions. It's a narrative of, navigating complexity while building for the long haul.
okay, that makes sense. Let's shift gears to Chapter 4. Outlook and key metrics. What forecasts did they give for the rest of 25 and beyond?
Right, so we mentioned the full year 2025 revenue guide, $250 million to $300 million. And the profitability targets, positive adjusted EBITDA run rate by end of 25 and positive adjusted EBITDA for the full year 26. That adjusted EBITDA focus is important, strips out some non-cash stuff.
All right, gives a clearer operational picture. What about their backlog? How much of that do they expect to turn into revenue soon?
Yeah, the CFO mentioned they expect to recognize about 45% to 50% of their Q1 ending backlog as revenue during the rest of 2025.
That's about half this year.
And then another 25% to 30% in 2026.
How did that full-year revenue forecast land compared to analyst expectations? You hinted expectations might have shifted.
Yeah, that $250 to $300 million range. It's actually a bit lower than some analyst forecasts that came out right after the Q4 earnings last time. But it seems more in line with more recent analyst updates. So maybe the market had already kind of tempered expectations a bit heading into this Q1 report.
Understood. What assumptions are baked into that guidance? What needs to go right for them?
Well, it assumes, continued successful execution on current contracts. Critically, it assumes they win new work, more CLPS task orders, hopefully that big LTV contract, and SNS growth.
Right.
It assumes they keep making progress diversifying and that government funding stays relatively stable. And they're definitely counting on recognizing those IM2 success payments here in Q2.
Okay. If you compare that revenue guidance to the backlog number, what does that imply about new business needed this year?
It really highlights how crucial new contract wins are this year. If they recognize, say, 45–50% of the Q1 backlog, that's roughly $120 to $135 million. But their guidance midpoint is $275 million. So they need to win and start recognizing revenue on something like, $140 to $155 million in new contracts just this year to hit that midpoint.
Wow. Okay, so business development is absolutely critical in the next few quarters.
Very critical. They need the pipeline to keep delivering.
Let's get quick updates on those key programs then, CLPS.
Revenue was up in Q1. They're pushing NASA for potentially larger, bulk buy orders for lunar delivery. They expect the IM2 payment in Q2, and IM3 is on track for the first half of 2026, incorporating lessons learned.
Good. LTVS, the lunar rover, that seems like a huge potential prize.
It really is. Revenue also up in Q1 there. Big step was completing the preliminary design review recently, incorporating astronaut feedback.
Oh, cool.
Yeah, and they're adding capabilities, autonomous driving tech, even a 16th G simulator. They sound optimistic about landing the main NASA LTV contract award by the end of this year.
Okay, fingers crossed for them on that one. NSNS, the network services.
Also saw revenue growth. They hit the first 2 milestones on their NASA contract worth $9 million in Q1. And they've already received funding, another $18 million, for the next 2 milestones, which should hit revenue in Q2.
Okay, good progress there.
Yeah, and the long-term play is using their relay satellites to host payloads for others, data services, essentially.
And beyond those NASA programs, what about those diversification efforts? Any updates there?
Yeah, a few interesting ones. The JETSON program with the Air Force, that's the nuclear electric propulsion, finished phase 1, and they expect a follow-on contract. They got that $10 million Texas grant for an Earth reentry vehicle, potentially for sample return, plus another contract win related to that.
Okay.
They won a contract, still being finalized, to adapt lunar tech for an orbital transfer vehicle for a government customer. And they finished a study for the Space Force on commercializing in-orbit servicing. So, lots of irons in the fire.
Definitely broadening their scope. Okay, KPIs, key performance indicators. What should people be tracking most closely?
All right, four main ones, I'd say. First, contracted backlog. It was $272.3 million at end of Q1, down a bit from year-end 24, but still a key forward-looking number. Management noted more NS&S value should hit the backlog in Q2.
Okay, backlog, number 2.
Gross margin hit 11% in Q1. That third consecutive positive quarter shows improving efficiency and value.
Got it. Gross margin, third.
Free cash flow. That positive $13.3 million is huge. First time positive. Shows financial health improving, ability to self-fund.
Right, FCF. And
Four.
Cash balance. That $373.3 million gives them enormous flexibility and runway. Liquidity is key.
Backlog, gross margin, free cash flow, cash balance.
Got it.
Yeah.
How are the overall profitability trends looking? You mentioned gross margin improving.
Yeah, gross margin trend is definitely up. Operating margin, while still negative at negative 16.1%, is improving sequentially. Net margin is tricky. Gap net margin looks positive because of some non-cash items. But the net loss attributable to Class A shareholders' margin is probably more reflective operationally, around NACNIC's 18.5%. That's why focusing on adjusted EBITDA and free cash flow really tells the story right now.
Understood. And cash flow generation, balance sheet health overall.
Cash flow from operations was strong positive in Q1. Investing cash flow was negative due to CapEx, as expected. Financing cash flow was strongly positive from that warrant exercise.
Okay.
Balance sheet looks robust. Tons of cash, no debt, according to the CFO, improving shareholders' deficit, and a healthy current ratio around 3, meaning good short-term liquidity.
Okay, putting this in context, how do they stack up against competitors, and what are the big industry trends?
Well, competitors are a mix: LUNR Outpost, Rocket Lab, Momentus, Planet Labs, Cetus Space, others. Rocket Lab, for instance, had higher Q1 revenue but negative FCF as they invest heavily in Neutron. MDA Space is bigger, growing well. AST Space Mobile is ramping manufacturing. Cetus reports soon.
So LUNR's positive FCF is a bit of a differentiator right now.
It is, compared to some peers still in heavy investment mode, yeah.
And broader industry trends.
Space tech investment was still strong in Q1 overall, maybe shifting a bit towards later stage funding, though. Defense tech is hot, early stage seems tougher, GeoAI is advancing. Headwinds, potential tariffs, geopolitics, market volatility, maybe U.S. spending constraints. Though LUN sees diversification as their shield there.
Okay. Last part of this chapter, risks and opportunities. What are the main ones?
Key risks. Execution risk space is hard, as IM2 showed. Contract dependency, especially NASA. The path to sustained profitability isn't guaranteed. Competition is fierce. Macroeconomic and funding headwinds. Limited operating history as a public company. Stock price volatility.
Standard risks for the sector, mostly.
Yeah.
And the opportunities.
Lots. Strategic diversification is huge. National security, reentry vehicles, OTVs. The shifting federal landscape could open doors.
Yeah.
Winning new contracts, especially LTV. That strong cash position enabling strategic moves, maybe M&A or faster R&D, their tech leadership in certain niches. And near term, that IM2 payment could be a nice catalyst.
Okay, great breakdown. Let's pull it all together now in Chapter 5, bottom line takeaways. So after digging through all this, what's the main takeaway from LUNR's Q1?
I think the main takeaway is they had a genuinely strong Q1. Solid sequential revenue growth, hitting that really important milestone of positive free cash flow for the first time.
Yeah, that stands out.
And ending with a very strong cash position. These are all markers of a business that's maturing and becoming more financially stable.
But as you noted, the journey to consistent overall profitability for the shareholders, that's still underway, right?
Oh, absolutely. Getting the gross margin positive and growing is excellent. It shows they can make money on the projects themselves. But translating that into sustained bottom line net income for shareholders, that's still the goal they're working towards. Progress, yes, but work still to do.
And it sounds like execution, just delivering on time, on budget, remains absolutely critical.
Paramount, yeah. Future success really hangs on successfully executing the missions they have and, crucially, winning the next set of contracts to keep feeding the machine. Reliability and performance build trust, which wins business in this industry.
Their diversification strategy seems like a really smart move for the long term.
I agree. Pushing beyond just lunar delivery into national security, Earth reentry, orbital vehicles. It feels like a necessary and potentially very rewarding path. It reduces reliance on any one customer or program, builds resilience, and opens up much larger potential markets.
And, of course, you always have to acknowledge the risks inherent in this business. Space is not easy.
Definitely not. It's complex, expensive, and things can go wrong. Setbacks happen. The key is learning from them quickly and effectively, like they seem to be doing post-IM2, and building robustness into future plans.
So looking ahead, what are the key things you'll be watching for with Intuitive Machines?
For me, it's new contract wins, especially that LTV decision, continued progress towards that positive adjusted EBITDA goal, successful mission execution, obviously, and any breakthroughs or major advancements in their key technologies, those will be the big signposts.
All right, so here's a final thought for you, the listener, to ponder. With Intuitive Machines building these capabilities and positioning themselves strategically, how might they actually shape the future of space infrastructure and services beyond the moon in the coming years? What emerging needs out there in the space economy do you think they're best positioned to meet?
Yeah, that's a really interesting question to chew on as they continue to evolve.
Well, that wraps up our deep dive into Intuitive Machines' Q1 2025 earnings. We really hope this breakdown gave you some valuable insights from the materials you shared with us.
And hey, don't forget, if you want more analysis like this, check out and subscribe to the Stock Analytics AI YouTube channel. They dig deep into innovative companies.
Definitely worth a look. And now, just the necessary disclaimers.
Right. Financial disclaimer. Please remember, everything we've discussed here is just for informational purposes. It is definitely not financial advice. Investing involves risk. You could lose money. Always do your own thorough research, and please consult with a qualified financial advisor before making any investment decisions.
And the AI disclaimer. This analysis was put together based on publicly available information. It's not financial modeling or any kind of prediction. While AI tools might have helped in gathering and analyzing some of the data, the insights and commentary you heard were generated by human expertise. Subscribe to Stock Analytics AI YouTube channel, Financial and AI Disclaimers.